Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Mahn, President and Chief Investment Officer of Hennion and Walsh, to discuss where to invest as inflation increases and the economy expands. Kevin, it's great to see you as always. Welcome back to Trade Talks.
Thanks so much, Jill. Great to be here.
And Kevin, what's your current view on inflation and outlook for the remainder of the year?
Sure. I think it's important to consider, Jill, that the Federal Reserve is trying to reflate the U.S. economy from the depths of the recession that we experienced back in 2020 at the onset of the COVID-19 pandemic. With that said, we did see in April significant surge in inflation, but we do agree with the Fed that some of those inflationary pressures are likely transitory in nature, such as airfare and other travel-related expenses, and even used car vehicles that are impacted by the supply shortage of areas such as semiconductors. So while I don't believe that that type of sustained inflation will continue, there will be more muted inflation likely for years to come, up until the point in time when the economy fully recovers to pre-pandemic levels, until we get closer to that period of full employment, which is roughly around 3.5%, where we were back in March of 2020.
How are you positioning portfolios during periods of inflation?
We look back to previous periods of inflation and consistent, strong inflationary environments. And a lot of people naturally refer to gold or other physical commodities as inflation hedges. And if you take out one specific time period, gold and other commodities aren't necessarily the best hedge against inflation. What has proven to be one of the best hedges against inflation over time are equities. Even more so, emerging market equities. So for a lot of the clients we speak to right now who are under-allocated internationally, whether it be developed market internationals or emerging market international equities, we think now might be the right time to consider adding international stocks to a globally diversified portfolio to help it hedge inflationary pressures, but also, Jill, to take advantage of upside growth potential, given how stretched U.S. equity valuations are right now.
Where do we stand in the economic cycle, and what's your outlook for economic growth? I guess the million-dollar question is, have we peaked?
Yes. No, we have not peaked as of yet. And if you look at the outlook for GDP this year, roughly over 7%. Next year, it's coming down a little bit, but still over 6%. And then it should fall back in time in more of that 3% range from that point going forward. So I would argue right now, Jill, we've come out of that initial recovery phase from the doldrums that we experienced last year. We're now in a multi-year expansionary phase. And during those expansionary phases, when credit accommodations are often better, there are certain sectors that historically have performed better in the stock market. And those are generally the more cyclical sectors that are also more value oriented, such as materials, industrials, financials, communication services, the same sectors that stand to benefit if and when an infrastructure spending bill is passed. So those are the areas that we'd look at on the equity side. And then on the fixed income side, you'd have to look for areas such as high yield, senior loans, and even municipal bonds to help provide income and growth potential during this economic expansion.
All right, Kevin, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.